think, act, and prosper. You are now tuned into the Money Level Show.
Hey, Gwen, glad to have you back on the show.
Thanks for having me. It's great to be here.
Yes, indeed. Yes, indeed. So, a lot has developed. Our last conversation, we went deep into whether it's recession or no recession. And I do want to get a update from you. Has your view changed on anything? What are you seeing at the Fed? There's been talk of a Fed pivot. Fed needs to cut interest rates, kind of back and forth.
Yeah.
Are we still in no man's land, or do you feel like there's some direction for the economy?
I mean, I think it's the more direction than there was when we chatted. Maybe it was 4 months ago or something than when we had that conversation. So I think there is more direction now. I mean, especially since the start of this year, through the month of January, the data has been really good. Like it's sort of, you keep waiting, the wary of us, which is a lot of us, keep waiting and being like, no, there's got to be like a bad shoe about to drop. But then it just hasn't. Like in the last month, it's been, blowout jobs report, and services ISM is stronger than expected, and manufacturing ISM is stronger than expected, and prices paid are increasing. And so the economy looks pretty darn good. That, of course, can shift, but right now it looks pretty good. That doesn't mean that the Fed won't cut rates, but of course the Fed is going to be cautious. The thing that they don't want to do is do something that people then see as being the cause of something bad, right? And the biggest risk of those is cutting too soon and having inflation return. And so they're very wary of that. Yes, they do want to normalize. I actually just before this call, I was looking at a summary of comments from members of the FOMC, the comments that they've made this month, or like in the month of January. And they're all very aligned. They're all like, look, the data is going in the right direction, and we do want to normalize. They're not using things like we need to support the economy, because that's not what cutting would be about right now. The economy is doing just fine. But we do want to normalize because rates are just high. So we want to normalize. So I think cuts will happen, but I don't think they're going to rush into them. I mean, right now, there's still sort of even 60% odds that things will get cut in May, which I think that's optimistic. I think we're looking at June at the earliest, because they just want a few more months of data going in the right direction. So, I mean, I think the risk of recession has receded significantly. These things can always change, for sure. We had another little banking crisis. I mean, crisis might be an overstatement of the description of what happened there, but like we had another banking situation that made people wonder, things like that can always crop up. But right now, the data looks pretty good. I think we're going to carry on for a while, and then we will get a rate cut, but more like in the middle of the year.
Yeah. I was thinking about that bank. I forgot the acronym for it. It's like
New
NC
York,
something.
yeah.
Yeah, New York CB or something like that.
Exactly. Yeah. Community
Yeah,
bank. Maybe it's New York
yeah,
Community
private
Bank.
private community bank. And currently the Fed, the program that they issued last year is supposed to expire in March. And so I don't know why the depositors got afraid for this particular bank. I mean, they've been trying to reassure the depositors, like, hey, we have enough money to cover the uninsured deposits and such. And this has been something that has been talked about for a while, that more regional banks will struggle in terms of after last year and the interest rates being so high.
Mhm.
Do you think that this is something that's going to continue? Do you think the Fed will pivot on canceling this program in March?
Yeah, it's a good question. I mean, I think the Fed has been pretty reliable in following through on what they say they want to do. And so like when they wanted to cut back their balance sheet, they have been doing that. Even though when they make these announcements, there's lots of reason to think that it's impossible, or they won't, or they'll have to backtrack, right? We're all cynics, and fair enough. Like we're in this crazy monetary world right now where the central banks are so involved in how everything works. It's very easy to be cynical that they could step back in any way. So I think they want to. I think they'll try, but at the same time, this new world means that they're very practiced at stepping in when needed. So I think what that means is they're going to try and step back. I think they're going to let the program end, unless they're given a very specific reason to not, in which case they won't hesitate to step back in and prevent a regional banking crisis, right? Like that's just how it is now. They're very practiced at playing those cards. They've sort of developed a pretty good toolkit of how they can do that. So that both reduces the risk of crisis from something like that, but also just sort of perpetuates this. Are we living in a reality, or are we living in sort of a Fed bubble, like a Fed protected bubble? That's a whole deep conversation, of course, whether the financial realities are being given the opportunity to play out versus being cushioned all the time. But I mean, that's certainly the playbook for now, the Fed is going to keep trying to step back, and they've been doing that. And to their credit, they have been, but they aren't going to hesitate to step back in if like an actual regional banking crisis started to appear.
How do you see the Fed and the current election year right now? A lot of people can't afford homes with interest rates this high, things of that nature. I'm wondering if there's going to be more political pressure from populist groups or such on during this election cycle. And so I'm wondering how that will play with the Fed, or if it will influence anything that they do in terms of like cutting sooner or anything of that nature.
I think Jerome Powell doesn't care about politics. And maybe I'm like he's been asked that question so many times in so many different ways over the years. And I mean, you feel like you get to know these people after listening to so many press conferences and having them be like so integral to sort of the research that you're doing. I actually don't think he cares. I think he only cares about inflation and employment and growth. Like I actually think that that's his focus. There's members of the committee who would not be quite as objective, if you want to use that word, as that, maybe have more political influence on them. But I don't actually think Powell cares. And so it's funny, even 6 months ago, I was like, okay, yeah, they're going to have to pull the rate cuts earlier in the year because they're not going to want to cut rates near the election because that would be seen as trying to help the Democrats or something. I actually don't care. I've changed my mind on that. I think they're going to cut rates based on data, or not cut rates based on data, and not actually pay attention to the election cycle. The impact of the election cycle is becoming very apparent in all kinds of other aspects of American life, but I actually don't think it's going to play into the rates decision.
So if the Fed were to cut rates, let's say mid-year, do you think that that would just issue a risk-on environment? Or some people say that the Fed cuts rates when something breaks. And so I'm like, okay, is the market going to go down, or is that going to be risk on, where these risk on assets are going to just skyrocket?
Yeah, so one thing that I've really liked about the fact that it's taken a lot longer to get to rate cuts than the market initially wanted, right? The market wanted rates to come down because there was this addiction to easy money. And so it was just like, let's cut rates so we can get back to easy money, so we can get back to, markets moving because liquidity is so high. And because it's actually taken a long time and the Fed has moved cautiously and rates have remained higher for longer, I feel like there's a bit more reality returned to traders. I am being somewhat naive here and like maybe seeing what I want, as opposed to, there's also still a lot of traders who are focused on rates and will make the trade when rates get cut, that like you say, that the risk on trade is back. But if we get the rate cuts in the setup that we were just discussing, which is, inflation continues to just edge down sustainably, but slowly, like it is now. Unemployment looks, stays fine. Maybe there's always going to be a risky report here on, jobless claims, but then there's going to be like a stronger blowout number over here. As long as things stay sort of in that line and the cut is based on normalization as opposed to cutting for support. If we get to some sort of crisis and they have to cut to support the economy, then we're in the recession game, right? Then we're in a different context. But if we remain in this context and we're cutting for normalization, I think it will support those risk assets because we are in a good economy and there's no reason to not bet, not be speculative when the economy is good. And then the Fed hands you this present of saying, we're actually going to literally support speculation by making and growth by making capital easier. So I think it will. I'm hopeful that it won't be such a dominant factor as it has been previously, that markets won't shoot to the moon only because of lower rates, and that there's a bit more sort of economic reality playing into fundamentals playing into markets these days. That's what I think is possible. Well, we shall see.
Yeah. So in terms of Fed cutting rates and such, how would that benefit because I'm wondering, like, obviously during the pandemic years, it's kind of weird, like we're like, almost 4 years into when the pandemic started. It's kind of weird,
I
like
know.
it's gonna get old talking about it, right, or something. But then the Fed was like buying government debt, and so
Yeah.
um, obviously there's this aspect of like quantitative easing. When is that going to start back up or not? When they cut rates, and then I'm kind of wondering who's going to be financing government spending currently. And so, what are you seeing on that front?
I mean, this is the huge question, right? Like the deficit spending, there's a deficit spending structure that's systemic in America, and there isn't a fix to that. There's no viable option to significantly cut spending or raise taxes. Those aren't viable options on the table. But spending needs are higher than income, so we're in a deficit situation. A couple months ago, I focused on that quite a bit and was looking at, whether a dearth of interest in US bonds was actually going to become a dominant factor in yields. And it felt like it for a moment there. It definitely felt like it for a moment. But then we started to get this sort of more sustained or clear economic strength from America, which sort of rebuffed that and made, I think, reinstilled some confidence in just going back to what's worked for a long time, which is buying American debt. Now, there's big picture things here that have shifted, right? Russia no longer buys any American bonds. China is selling treasuries. Like its holdings keep falling quite significantly. There is also just the way that corporations have worked, or regional banks hold their money, is what I meant to say. They are also buying far less of government debt. So there is a shrinking pool of buyers, but for US debt. But we're starting with the biggest, most liquid, most important market in the world. So it turns out when you're that big, you can shrink quite a bit and still work. So I think it's kind of like, the concepts of deglobalization and de-dollarization, which took 2 decades, maybe I'm exaggerating a bit, but easily a decade before those concepts started to manifest in tangible ways. I feel like that's where we are with the bonds, the US bond thing as well. Like the concept is present. It makes sense. It's a valid concept because the pool of buyers is shrinking. But I don't think we're at the point, or even very close to the point yet, where we're actually short on buyers for US debt. It's going to happen, but I don't think we're there yet. So it's part of the process. It's like an undercurrent, but I don't think it's going to impact bond yields like this year. I'm not worried about that in the near term.
What do you project the national debt will be by the end of this year?
I don't know. Higher.
Definitely. Okay. Well, so if the Fed does cut rates, I mean, gold's performed well in this high rate environment. It's been struggling a little bit lately, but it's performed well overall. What do you see? What do you see happening with gold when rates get cut?
Yeah, I mean, that's the thing, right? As a gold investor, I'm sick of talking about rates because all we've done is talk about rates for like a decade, and it's getting old, but it still is the thing. So I wish we could stop talking about rates, but as a gold investor, man, I wish that rate cut would just happen because, like you say, gold has performed remarkably well. Like it's actually been astounding how well gold has done through over the last 3 years through this rate hike cycle. Like unbelievably well. And I think that's largely due to central bank buying. There's been really unprecedented levels of central bank buying because that de-dollarization, deglobalization, those processes are real now. And so central banks are getting gold as their hedge against the unknowns involved in that. So gold's done super well, despite facing the most significant headwind that the yellow metal faces, which is higher interest rates. So it is a sea change for gold when rates get cut. So I do think that gold is going to break up through this. It's been so boring. It's done super, super well, but unfortunately that means it's just been a very boring price. It has just been sideways, mostly, right? For 3 years, it's been sideways. And no investor flocks to a sideways market. That's not what investors do. They wait for a market to move higher. And so I think that will happen with the rate cut. Like I say, I wish that were happening tomorrow for my gold investing reasons. I think it's actually not going to happen until the middle of the year, but I do think that it's going to move higher then. And I think that there is quite an awareness built in of gold's relationship to rates. And so when that cut happens, I think there's a good generalist investor awareness that one of the key plays for a rate cut is to buy gold or gold miners. And that matters because there's just been no interest in our space, right? Like I say, investors don't care about a sideways market. There's been no interest in the space for so long. Valuations are historically low based on almost any metric you can conjure. And so if we do get some of that generalist interest being like, oh yeah, rate cuts, I know a trade for that. It's buy gold stocks. I think it could have a pretty significant effect. I wish it were happening tomorrow because that would just be fun. And I think we might have to wait until like the summertime, later in the summertime. But I do think it's going to be big. And there was a big series of conferences here in Vancouver in January. There always is a big set of mining conferences. And I got to catch up with a bunch of, investor friends at those events. And I didn't expect to leave those events feeling more bullish. I kind of expected to come away being like, okay, yep, we're all just treading water, waiting. But there were a few conversations that I had with really really successful investors who haven't been in the gold space for years because they just haven't seen any reason to be in the gold space, who now are buying because they think that this is the year that this change is going to happen. So I actually did leave feeling a little more bullish. Not that it's happening tomorrow, but that this year is going to be the year that those major gold stocks can re-rate in like a low risk trade.
Yeah, definitely. So looking at like the gold chart, what's the longest amount of time we've consolidated above $2,000? I mean, I don't remember it staying above $2,000 for how long it's been this
Yeah,
time.
no, I think you're right. I mean, it's easier to reference that it hit a couple, it hit all-time highs twice in January, but I think you're right that this is probably the longest time it's spent above $2,000. Yeah, it's an impressive thing. And that sort of has that impressive performance through the rate hike cycle is continuing now in so much as even just, 6 short weeks ago, that was when Powell or 8 weeks, whatever it was, in his December press conference was like, we will cut rates in 2024. And that was when the market was like, 6 rate cuts, here we go. And gold shot up and made those new highs. And in the last 6 weeks, those expectations have had to like reel back. Reality has set in. Okay, it's not going to be 6 cuts. It's going to be 3 cuts. And they're going to start halfway through the year. But gold has, like you said, remained above $2,000. So this outperformance against the forces that would usually be expected to pull it down really continues. It's very impressive. So it's like people are just waiting for the moment, and we just unfortunately have to wait a little bit longer yet, but it's coming.
Mm-hmm. And what's your take on silver? I think I've been pissing off a few silver stackers. I'm a silver stacker too, but it's just I don't know the performance of it, which I understand like the supply demand and we have less supply now and all those things, and obviously silver moves when it wants to move, and it does rip pretty fast. Um, but yeah, I mean gold is still remaining very close to all-time high. Silver's still down, and some people are just kind of getting weary, And I've probably turned more into a gold bug over this time than a silver bug, even though silver has the most potential upside. So, what's your take on silver?
Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
My take on silver, my sort of big picture take on silver, is that over the last decade, it has become increasingly an industrial metal instead of a precious metal, right? And it's just the number of industrial uses and really significant industrial uses just keeps increasing. And at the same time, the overall investor world has become less interested in investing in precious metals. Like we say, it just investors haven't really cared about precious metals. So you just take a shrinking amount of interest in precious metals in general and an increasing influence from supply and demand, the industrial side of silver, and the dynamic is just different than it used to be. Like I, to be blunt, think of silver as an industrial metal. I don't really think of it as a precious metal anymore. So it's on a different timeline. It's on a timeline where it will rise when two things happen. And one or both of these could be the thing. And they are, we actually run out of silver. Like, users can't get the metal that they need. So that's just supply demand actually rises up in your face, as happened with uranium. Or we just get to a state where investors are comfortable positioning for global growth. We're not there right now. Like every news page that you open is about like the risks in China and slowdowns and even though we've had all this robust data from America, it's still taking a long time to actually develop confidence enough that investors' outlooks are based in positioning for growth. And I think investors need to be positioning for growth before they start buying commodities. That's the reason to buy copper or silver or nickel or zinc. It's because, heck, the world is growing. The world needs these things to grow. I will buy them. Oh, it's also helpful that there isn't enough of them. Like there's a supply demand argument as well. But and we're not at that point for silver. We haven't run out of the metal and investors aren't yet positioning for global growth. Exactly the same statement applies to copper. There's lots of strong arguments for why copper should do well in the medium term, but we're not there yet because we haven't actually run out of copper and we aren't in a position where investors are positioning for global growth.
So, is this a time where, obviously we can't speak or give financial advice, but would you say this is a time where you would consider buying copper, or would you be a little more patient in that market?
I'm not actively looking for copper exposure right now. I am always interested in copper discoveries. So discoveries of new deposits can work phenomenally well no matter what's going on in the metals space, right? There's been lots of examples of that over the last 10 years of largely boring metals markets where there's been, uranium discoveries, copper discoveries, gold discoveries that have done phenomenally well, even though the metals markets overall have been boring. So discoveries, I'm always open to looking at a copper discovery play. And then that's of course its own investing challenge because you have to have the expertise to assess those things. But I'm not looking for sort of overall copper exposure right now. I don't think that opportunity is going to play out in a significant way this year. If it starts to, I mean, I'll absolutely keep my eyes open. Like if this data continues to be robust and investors do start saying, heck, this is a growth environment. Or, I mean, there's also the politics side of things here where there's going to be a lot of positioning around the election and people trying to decide whether, investing green, investing infrastructure is a blue result, is a red result. Like there's going to be a lot of that to consider. And we don't have answers to those questions yet. So I think we're not close enough yet, and there's a lot of unknowns. We are, in a copper deficit, but copper is always a very tight market. It's an incredibly large, essential market that's always like on a tightrope, which is interesting in and of itself. And we don't need to, I'm sure you've talked many times on your channel about the fact that we haven't been building enough copper mines. Like over a couple year period, we're starting to get that tight market starts to get into trouble. Like we are not building enough copper mines, but we're not there yet. Like I mentioned before, uranium, the market moved when we actually ran out of uranium. We have not actually run out of copper yet. Uranium, it took 6 years to work through all the stockpiles and like the warehoused uranium and the leftovers from Japan's utilities that weren't using it. The same thing is playing out in silver and in copper. Remember all those warehouses of copper that were used as leverage to get into the housing market in China? Like that copper is all what's being used to fill the gap, and we're working through it. We're working through the excess. We'll get to the uranium point, but we're not there yet.
Mm-hmm. Yeah, that's very interesting. So with uranium, currently we still have a deficit in the amount of pounds available, and then we had the Kazatomprom information come out regarding them not being able to meet like production targets or whatnot. So what's the magnitude of this for the uranium markets? Because now are people looking to Cameco or like what are people looking at here, or are we just in an environment where it's just going to have to work itself out over time?
So the two companies that you just named, Kazatomprom and Cameco, are responsible for the vast majority of uranium production in the world, right? Kazatomprom's 40%, Cameco's 30%. Big, like huge players in this space. The Kazatomprom news, they warned us in January that they were going to make this announcement at the beginning of February. And so at the beginning of February, they gave us the details on how much less how much less of an increase they're going to be able to manage. And it turns out the increase that they're going to be able to manage is a fat zero. Like they're not going to be able to increase production. And what's really the notable thing about that, there's two notable things. First of all, as this uranium market has gotten going, I get it. Uranium markets in the past have been incredibly sharp ups and then like immediate downs because a bunch of uranium has come out of the woodwork or producers have been able to turn on the taps and like respond. And so it's been a real spike as opposed to any kind of sustained opportunity. And so there's a lot of cynicism around this uranium market. I get it. That's people have had experience and been burned. So it's fair enough that they're being cynical. But Kazatomprom's announcement said, we weren't in 2023 able to increase production. We aren't going to be able to increase production in 2024 because we can't get enough sulfuric acid to make the new wells for the new mines that we're supposed to expand our production. And there's no quick answer to that. There just isn't. And so Kazatomprom was the main thing that people pointed to when they said, somebody's just going to turn on the taps and produce more uranium. People were like, well, Kazatomprom, they can just pump more acid down and pull more uranium out. And Kazatomprom's like, wish we could. We actually can't. Like, we would love to produce into $100 uranium market more, but we actually are unable to do it because we can't get the sulfuric acid. So I think that just really negates one of the opposing arguments to this bull market. Like, they can't do it. And then just today, I haven't had a chance to go through it in detail, but just this morning, Cameco released its guidance, and that also is really significant because, like I said, they're the other biggest player in the market. And at the end of the day, they are also very constrained in being able to increase production. There's not enough skilled labor. There's equipment issues. Like, it's just hard to produce more from these sort of complicated high grade mines in the Athabasca Basin. It's just really hard to increase production there. And we've drawn out all of those excess supplies. That's what those 6 years of working through the excess was. So there isn't an answer. It just has to, the answer is higher prices for long enough to incentivize significant new mine builds. We're in a new paradigm for uranium pricing. I don't think that this is going to spike and turn down at all. I think this is a new paradigm for uranium pricing.
Mm-hmm. And could you give us a picture? So with the current deficit and the amount of pounds, like how many pounds are normally produced each year in terms of, like, if we have like a 40, 50 million pound deficit, how long does it take to even like cover that amount of ground?
Yeah, I mean, so yes, the market is something like, and I'm not going to have these numbers perfect, so I'll apologize ahead, but it's something like 195 million pound market, and we're producing something like 160 million pounds. Like that's the sort of gap. And then to complicate that, of course, we're also dividing this market in half, like East and West, and because of politics. And the West side is ending up even worse off, actually, than the East side. The West gets more of the deficit than the East does when you draw that line down the middle. How do you fix that? A very good question, my friend. I mean, there are stockpiles of uranium, which are like the Sput Physical Uranium Trust and Yellowcake. These are the financial players who have stockpiled uranium over the last few years because they saw this. They were creating and then wanting to play precisely this bull market opportunity. At some point, those stockpiles will probably have to come into play because utilities will just say, like, we are going to have to shut down our reactors if we can't get uranium. And so at some point, I don't know whether it's like even a government requirement or what it would be, but at some point, those stockpiles will probably have to come in to bridge the gap because you need big new mines. Now, when's the next? So there's a few mines that are coming online. Certainly there's a few in America that are coming online over the next year and a half. A lot of those are sort of what we call the easy pounds, the restarts of ISR operations. And there's some expansions. And there's a few new operations that are going to come in to play, especially up in Canada's Athabasca Basin over the next, call it 5 years, that will, if NextGen's Arrow gets built and starts producing, it will produce 30 million pounds of uranium a year. But it's still actually waiting for its provincial, or it's one of its two, the federal or the provincial environmental approval, and it needs to finance, $1 billion, which it will be able to do. And then it needs to build a mine. And guess how long? That takes 2 years, right? Like you can't snap your fingers and build a really complicated underground uranium mine. It takes time. So that's the kind of time frame we're looking at before we get to the kind of answers that solve the problem.
Mm-hmm. So it sounds like government is still in the way in terms of having to wait, to get licensing, wait to get, approvals, and they're slow to stamp the paper, like like.
This is an interesting aspect of the uranium market. It's a little bit of a side note, but like the other big thing in uranium is talking about small modular reactors, right? And how small modular reactors could be a really important part of the energy solution for, isolated communities, isolated projects. There's lots of applications where like a small modular reactor there's lots of reasons why it's the right answer. The lowest environmental impact, lowest carbon emissions, and all of that. But there's been the United States no one's created a different permitting process for a small modular reactor. Those things have to go through the same permitting hurdles that a massive, brand new, full-scale nuclear utility has to go through. And guess what? The requirements there are, like, not surprisingly, as high as you could possibly imagine. And that, it turns out, is not appropriate it is actually making it impossible. The reason that the small modular reactor that was the most advanced and the most likely to actually get built in America was just canceled a couple months ago is because they can't get through the hurdles, and financiers and utilities can't have enough confidence that they'll get through the hurdles to sign on. So it's a chicken and egg, and the hurdles are just stopping either of them from happening. So at some point, this government impetus to increase nuclear, which is very real in America, right? They're creating a strategic stockpile. They're doing lots of things to try and support domestic uranium and nuclear energy. At some point, that focus is going to have to shift to creating a slightly different permitting regimen for things like small modular reactors if they actually want those to be part of the solution. Because yes, the permitting barriers are just sky high and then a little bit higher.
Mm-hmm. Yeah. That makes total sense. So what is the most what commodity are you most bullish on at this time?
Uranium. I know that seems like uranium's already doubled in the last 9 months, right? So haven't we missed it? I don't think we have. Like, uranium is trading at $100 a pound. I think $150 a pound at the end of the year is very likely. I think the equities have not responded, have not provided the leverage to the move yet that they might have. Some categories have, the companies that are starting new production in America, the uranium energies and the encore energies, they have provided great leverage because they are literally the answer to the problem. And so, sure, they got the most first interest. But if you go down the food chain just a little bit, the bigger explorers, uranium explorers in the Athabasca Basin, they haven't benefited to the degree that they should for this kind of sea change in the market. So I think there's a lot of upside left for uranium equities, even just at this uranium price, let alone because I think that the uranium price is going to go higher. So uranium's the one that I have the most conviction on for sure. I mean, I also have a lot of conviction that gold is going to go this year. It's just like we said at the beginning, it's just going to take some patience. Like, it's going to be 5 or 6 months before that plays out because we need that rate cut to happen. And I don't think that Powell is going to rush that at all. So I'm an impatient person, so I want something that I can do now. And uranium is happening right now.
Yes. Well, thank you for coming on, Gwen. Appreciate you for spending your time with us today. Where can people find more about you and the work you do?
Well, it was a great conversation. Thank you for having me. My website is resourcemaven.ca. That you can find my newsletter there. You can find all kinds of free content, all the links to my shorts and reels and Twitter and all that. Resourcemaven.ca.
All right, thank you.